Welcome back to the channel. I'm Algabot, and today we're taking an educational look at an expert advisor for MetaTrader 5 called Kernel Regression Envelope Reversion. This is a mean reversion approach built on a smoothing technique called Nadaraya-Watson kernel regression, wrapped in an adaptive envelope. Over the next few minutes, we'll break down how it estimates fair value, how it decides when a market is stretched too far, and how it waits for price to begin snapping back before considering a trade. We'll walk the exact logic, read the code, and follow an illustrated chart together. Remember, this is educational information only. Let's start with the big picture. Kernel regression envelope reversion is a mean reversion strategy. That means it doesn't chase momentum. Instead, it assumes that in a balanced market, price tends to wander away from a central fair value and then drift back toward it. The clever part is how it defines that fair value. Most systems use a simple or exponential moving average. This one uses Nadaraya-Watson kernel regression. In plain terms, it takes the last several closing prices and blends them into a weighted average, where the most recent bars carry the most weight and older bars fade out smoothly according to a bell-shaped curve called a Gaussian kernel. The result is a very smooth estimate of fair value that has less lag than a long average and less whipsaw than a short one. The strategy calls this line the kernel line. Around that line, it builds an envelope. It measures how far, on average, recent closes sit from the kernel line, a weighted dispersion, and places an upper band and a lower band, a set multiple of that distance above and below. Because the envelope is built from the market's own recent variability, it automatically widens when the market is choppy and tightens when it calms down. Now, fading stretched price only makes sense when the market is ranging, not trending. So the strategy adds a regime filter. It measures the slope of the kernel line over a look-back window and normalizes it by the average true range. If that slope is steep, a genuine trend is likely underway, and the strategy simply stands aside. It only looks for setups when the kernel line is relatively flat. This approach is designed with liquid foreign exchange majors or an index in mind, on intraday timeframes from 5 minutes up to 1 hour, where balanced ranges are common. It suits a trader who is curious about statistical smoothing and disciplined, rule-based mean reversion. As always, trading involves risk, and losses do occur. Let's walk through the exact logic, step by step. On each newly closed bar, the strategy first rebuilds its kernel line. It loops over the most recent closes, assigns each one a Gaussian weight based on how far back it sits, and divides the weighted sum of prices by the sum of the weights. That gives the kernel line the smooth fair value it calls NW. Next, it measures dispersion. Using the same weights, it averages the absolute distance between each recent close and the kernel line. That weighted mean absolute deviation, multiplied by the band setting, defines how far the upper and lower bands sit from the center. The upper band is the kernel line plus that amount, and the lower band is the kernel line minus it. Then comes the regime gate. The strategy looks at where the kernel line sat a few bars ago, takes the difference against its current value, and divides by the average true range. If that normalized slope is larger than the maximum allowed, the market is trending too hard to fade, so it stops right there. Only when the slope is small does it continue. Now the entry conditions. For a long, the strategy checks whether the just closed bar's low pierced below the lower band, showing an overstretch to the downside, and whether that same bar then closed back above the lower band, showing the reclaim. It also requires the bar to be bullish, meaning the close finished above the open, confirming the snapback has begun. When all three line up, it buys. The take profit is set to the kernel line, the central magnet, and the stop loss is placed 1 ATR multiple below the entry. The short side mirrors this exactly. The bar's high must pierce above the upper band, the close must return below the upper band, and the bar must be bearish. Then it sells, targets the kernel line, and places the stop 1 ATR multiple above entry. Before any order goes out, a reward-to-risk filter rejects setups where the kernel target is too close to justify the stop distance. A spread filter skips expensive conditions, and only one position per magic number is allowed, so the stop and target manage the exit cleanly. Let's read the actual MetaTrader code on screen. At the top are the input parameters you can adjust. Kernel period, set to 25, is how many closed bars feed the regression. Bandwidth, at 8, controls how smoothly the Gaussian weights taper. Band multiple, at 2 sets the envelope width as a multiple of the weighted dispersion. SlopeLoopback and MaxSlopeAtr define the regime filter, allowing fades only when the kernel slope stays under 1 ATR. ATR period and ATR stop multiple drive the stop. Min reward risk rejects thin setups. Max spread point skips costly spreads, and magic keeps one position at a time. Now the long block. The condition reads, if the close bar's low is below the lower band, and its close came back above the lower band, and the bar is bullish. When that is true, entry is taken at the ask, the take profit TP is set to the kernel line NW, and the stop loss sits one stop distance below entry. It computes reward and risk, and only if their ratio meets the minimum does it call trade.buy with those stop and target levels. The short block is the mirror image. If the close bar's high pierced above the upper band, the close return below it, and the bar is bearish, entry is taken at the bid, TP is again the kernel line, and the stop sits one stop distance above entry. After the same reward to risk check, it calls trade.sell. Both sides target the same central line and let the ATR stop handle the downside. Let's bring the logic to life on this illustrated chart. Running through the candles, you'll see 3 lines. The gold line in the middle is the kernel line, the strategy's estimate of fair value. The 2 blue lines above and below it are the upper band and the lower band of the envelope, built from the weighted dispersion around that center. Notice how gently the kernel line drifts here. That flatness is exactly the balanced, ranging condition the regime filter is looking for, so the strategy is willing to consider fades. Watch the opening candles. Price begins near the kernel line and then starts sliding lower, candle by candle, drifting away from fair value toward the lower band. On the third candle, price stretches hard, dipping its low well beneath the lower band. That is an overextension to the downside. But the strategy does not act on that stretch alone, because the market may still be extending, and it does not want to step in front of a bar that is still falling. Instead, it waits for the reclaim. On the very next candle, price again pokes below the lower band with its low, but this time it pushes back up and closes above the band, and the candle finishes bullish with the close above the open. That is the exact combination the strategy is looking for: overstretched, then reclaimed, then turning up. The buy entry marker appears here. The stop loss is placed 1 ATR multiple below the entry, resting beneath that fresh low, and the take profit is set to the kernel line, the magnet price expects to drift back toward. Now follow the recovery. Price lifts off the lower band, climbs back through the middle of the range, and by the 5th candle it reaches the kernel line. That is where the take profit target sits, and the long idea is complete. Price traveled from a stretched low back to fair value, which is the whole thesis of mean reversion. Then the market swings the other way. Price keeps rising past the kernel line, and, on the 8th candle, its high pierces above the upper band. Overextended, this time to the upside. Again, the strategy waits for confirmation. That same bar closes back below the upper band and finishes bearish, with the close beneath the open. The sell entry marker appears here. The stop loss goes 1 ATR multiple above the entry, above that fresh high, and the take profit is once more the kernel line. Finally, price rolls over and eases back down. By the 10th candle it settles onto the kernel line, and the short reaches its take profit target. Both trades share the same simple idea. Wait for price to stretch away from fair value. Wait for the reclaim that confirms the snapback has started, and aim for the return to the center. And remember, this is a clean illustration. Real markets are noisier, setups can fail, and losses are a normal part of trading. That wraps up our educational look at kernel regression envelope reversion. We saw how it builds a smooth fair value line from a Gaussian-weighted kernel regression, wraps it in an adaptive envelope from the market's own dispersion, and only fades stretched price when the kernel line is flat enough to signal a balanced range. We walked the long and short entries, the reclaim condition, the kernel line target, and the ATR-based stop, and then followed both trades on the chart. If you found this breakdown helpful, please like the video, subscribe for more MetaTrader 5 strategy analyses, and leave a comment with the strategy you'd like explored next. You can find more at www.algobot.live. Everything here is educational information only and not financial advice. Past performance does not guarantee future results. Trade responsibly.